Hello everyone, I'm John with JP Strategic Investments, and today I'm going to go over my predictions for which company Tesla will replace in the S&P 500. We'll go over some of the most likely companies to be replaced, why they could be replaced, and how it might affect their stocks. And really quickly before I dive into this, videos like this take a lot of time and research, especially because I'm dealing with a lot of stocks that I'm not already familiar with. So if you do find this video helpful, if you could hit that like button, I would really appreciate it. And if you enjoy in-depth stock analysis like this, don't forget to subscribe and hit that notification bell. Now with that out of the way, let's dive right into the video. So the S&P announced that they will name the company that Tesla will be replacing from the S&P 500 on December 11th after market close. So for many of you traders out there, this could be an opportunity to make some bets on which company will be removed, because not only is there a chance that their stock could decline on the announcement date, but depending on the size of the market cap, it could also have a decent drop on the actual inclusion date. This is because just as the immense buying pressure from the S&P is expected to boost Tesla's stock, the selling pressure on the stock being removed could cause that stock to drop as well on December 21st. Also, even if you're not a short-term trader, many of these stocks are recovery stocks that some of you might own. So it is a good time to just take a look at your positions and evaluate and see if any of those companies could be in jeopardy of being removed. So essentially what I'm going to do here is go through the worst 20 performers of the S&P for this year and see which companies are the most likely candidates for removal. Now, there's obviously no guarantee that the companies being removed will be from the bottom 20 performers of this year, but it is a good place to start. I will also be going over a few other companies at the end that aren't on this list but could be likely candidates for removal. Also, be sure to let me know in the comments below what company you think Tesla will be replacing, and if you do guess it right, I'll be sure to give you a shout out in my next video. So the first two companies on this list I want to address are the airlines. Now, as you can see, there are two airlines here in the bottom 20 performers of the list, and those two companies are American and United Airlines. Now, obviously this isn't surprising as the airline industry has taken a huge hit from the pandemic. Many airlines are currently losing tens of millions of dollars every day as air travel is very slowly coming back. That being said, I believe the S&P is more than likely going to be removing a company whose business was declining before the pandemic and also whose business is going to decline in the future. While the airlines are hurting right now, air travel is not going away anytime soon, and these two companies are more than likely going to recover and continue to grow. For this reason, I think it's unlikely that Tesla will be replacing either of these companies, and so I'm going to mark them in green. The next two companies we have here you probably all recognize as well, and these two companies are Carnival and Norwegian Cruise Lines. Now, these companies are also in the similar boat as the airlines, with business hurting from the pandemic, but people who want to go on cruises will also still likely want to go on cruises after it is safe to do so. That being said, Norwegian's balance sheet is a little more worrying than Carnival or the other cruise lines, and so for this reason I'm going to mark Carnival in green, but I'm going to mark Norwegian as yellow as it's slightly more likely to be removed from the S&P. Next up, we have Wells Fargo. Now, at first this one surprised me. I understand that low interest rate environments are bad for banks, but if we look at the other major banks here, we can see that they actually aren't doing too bad, with Goldman Sachs and Morgan Stanley actually positive for the year. So why is Wells Fargo down so much when the other banks are up? Well, part of it is because these other banks are investment banks that are better equipped to perform well in volatile economic periods. This is because they make money off of increased trading. The other reason is that Wells Fargo has had a series of bad earnings reports coming in well below analyst estimates. This combined with the bank still suffering from the consequences of its false account scandal has been heavily weighing on the stock. Not to mention the fact that Warren Buffett has also begun to trim his position in the stock recently. While this is not good for Wells Fargo, I do think the business will be able to steadily recover as the pandemic subsides. Also, generally the S&P removes companies with much smaller market caps. Remember that just because Wells Fargo might not be in a great position right now, that doesn't mean that there aren't other companies in the S&P that are doing even worse, as you'll see soon. For these reasons, I think it's unlikely that Wells Fargo will be removed from the S&P. That being said, with how large the market cap is, if the stock is removed, we will likely see a very large reaction in the stock. The next stock I want to go over here is Simon Property Group. Now, Simon Property Group is a real estate investment trust, or REIT. REITs are generally companies that own rental properties and essentially allow people to invest in real estate through owning the stock and collecting dividends. So Simon specifically owns properties like malls and other shopping outlets. Now, obviously these properties aren't doing very well in the pandemic, and many of their tenants aren't able to pay the rent because they're barely doing any business. Furthermore, mall traffic in general has been declining in recent years. Looking at a list of their top tenants, I personally would not want to be renting properties to dying companies like The Gap, Macy's, JCPenney's, or Sears, many of whom have already filed for Chapter 11 bankruptcy. For this reason, I'm putting Simon Property in orange as likely to be removed from the S&P 500. Next up here on the list is a company called First Energy Corporation. First Energy is an Ohio-based electric utility company. Now, the interesting thing here is that their poor performance this year seems to have little to do with the company's performance itself, but instead it has to do with an investigation regarding bribery of government officials. The company has been under investigation now for several months after allegedly paying a $4 million bribe to an Ohio state official. Later on, there was also worries that the company was out of compliance with the New York Stock Exchange, which turned out to be a misunderstanding, but all of this looks very bad for the company. That being said though, I think the S&P will probably just let this investigation play out rather than preemptively removing this company from the S&P. For this reason, I've marked them in yellow, meaning it's possible but not very likely that they will be removed. Now, looking at the list here, there's something that all of the remaining companies have in common. They are all oil and gas companies. Now, of course, this isn't surprising as oil prices tanked earlier this year as demand essentially disappeared. And while oil prices have somewhat recovered, the oil industry has been declining for some time now. If we just take a look at the chart here, we can see that bankruptcies among oil companies have been steadily growing since 2015. Oil company debt also has been on the rise, understandably. In fact, just in 2020 alone, over 40 oil companies have filed for bankruptcy. Not only that, but just from looking at future trends like electric vehicles and the push for clean energy, it seems very likely that the oil industry will continue to decline. Lastly, it just seems very fitting that Tesla would kick an oil company out of the S&P 500. Especially because if the S&P is adding Tesla, then they are essentially agreeing with the idea that electric cars are the future of the auto industry. And they will in turn be admitting that many oil companies will most likely be going out of business in the next 5 to 10 years. So instead of making this a very long video and going over each of these companies individually, I've just filled them in here based on the research that I've done, mainly relating to the company's financials and any other major factors relating to the health of their business, with the companies in red being in the most precarious situation in my opinion. Also, I will attach a PNG of this chart in the description of the video just in case you're interested in looking at it further. Now, as I mentioned before, there's no guarantee that the company Tesla will be replacing will come from the bottom 20 performers. There's a lot of guesswork here, and what I may consider to be a bad stock may be different than what the S&P committee considers. That being said, I'll just name a couple other companies here that aren't in the bottom 20, but that I think could still be at risk of being removed. The first ones here are a few more real estate investment trusts who barely made it out of the bottom 20. These companies are Vornado Realty Trust, SL Green Realty Corp., and Federal Realty Investment Trust. These companies own rental properties like office buildings and shopping centers, putting them in a similar position to Simon Property Group. As many companies are considering permanent work-from-home scenarios for large groups of their employees, some of these REITs could be in pretty bad situations. Another company I want to mention here is Xerox. Obviously, the need for printed goods has been declining and will slowly continue to as trends move further towards online media. The recent pandemic has weighed on this industry even further as schools move to distance learning and many people have been working from home. Xerox's revenue has also been slowly declining over the past few years, and although the need for printed goods is not going away, it's not necessarily an industry any business owner wants to be in. Lastly, there are a few other oil companies sitting just above the bottom 20 performer mark, and I'm not going to go over all of these, but pretty much any of these oil companies in the bottom 30 or 40 performers could be at risk of being removed. So there you have it. Those are the companies that I think are likely to be replaced by Tesla in the S&P 500. Again, these are just my best guesses and we'll have to wait and see. If you're looking to make any trades in relation to a company being removed, the largest moves will most likely happen immediately after the announcement on December 11th or on the effective date of December 21st. I hope you found this video helpful, and if you did, please consider liking and subscribing. Also, don't forget to put your best guess for the company you think that Tesla will be removing in the comments below. And other than that, have a great day.